Fetch.ai just got added to the Coinbase 50 index, while trading 80% down from its December peak. CNBC is covering their AI agent platform. Major logistics companies are integrating their technology, and the chart's showing a textbook descending wedge at oversold levels. Here's what most people are missing. Institutional validation is happening while retail's looking away. I'm going to show you exactly why this 30-cent level might be the accumulation zone we look back on, the technical structure that supports this thesis, and my specific strategy with exact entry and exit points. Fetch is currently trading around 30 cents, down from $2.20 in December 2024 and about 90% off its March 2024 all-time high of $3.50. The broader market's been consolidating, and AI tokens specifically have taken a beating, despite the narrative getting stronger. Volume's been declining through this downtrend, which is actually what you want to see in a bullish wedge pattern. Why this video matters now comes down to timing. We're seeing a convergence of technical oversold conditions with major fundamental developments that haven't been priced in yet. The market is treating Fetch like it's just another AI token, but what's happening behind the scenes with institutional adoption tells a different story. But there's something in the fundamentals that changes this entire picture.
Let's talk about what separates Fetch from the noise, because this is about actual infrastructure being built. Fetch.ai is the foundation layer of the ASI Alliance, which recently merged three major AI projects: Fetch.ai, SingularityNet, and Kudos. Their combined mission is creating decentralized AI infrastructure. And they're not just talking about it. On November 16th, Crypto Foxy highlighted something critical. Fetch got included in the Coinbase 50 index. This index serves as crypto's equivalent to the S&P 500, capturing the market's most influential digital assets through fundamental screening and dynamic selection. That's institutional validation. 2 days ago, CNBC published a video segment titled "The Agent Economy: How Autonomous AI is Rebuilding the Internet Around Us," featuring ASI1 and Fetch. When mainstream financial media covers your technology with that framing, you're past the experiment phase. They're positioning AI agents as infrastructure, not speculation. The product launch that matters is ASI1, their Web3 native large language model engineered for autonomous agentic workflows. They've deployed 5 specialized models: Mini for everyday workflows, Fast for real-time applications with ultra-low latency, Extended for complex analysis, Agentic for built-in agent orchestration, and Graph for data visualization. Those models are live. Real-world integration just happened. Yesterday, Fetch.ai announced ASI1 integration with Freight Technologies, bringing AI-powered agents directly into logistics. From dispatch to delivery, they're automating communication and streamlining operations for an industry that moves trillions in goods. That's revenue-generating utility. The infrastructure stack is expanding. ASI Cloud provides permissionless GPU and AI inference with transparent pricing and pay-per-token access to open-source LLMs. The innovation stack enables developers to build intelligent, multi-agent applications with native support for data, compute, governance, and orchestration. And ASI Chain, their modular blockchain optimized for decentralized AI coordination, just launched its DevNet closed beta in late October, with testnet coming next. This is definitely infrastructure being adopted, while the token trades at beaten-down levels. That disconnect is what creates opportunity.
Now let's look at what the chart's telling us, because this is where the risk-reward gets interesting. We're on the weekly time frame, which filters out noise and shows us the structure that matters. Fetch peaked at $2.20 in December 2024, then carved out a descending wedge pattern, those converging orange dashed trend lines coming down from that top. Price recently tested the lower boundary near 20 cents and bounced back to current levels around 30 cents. Descending wedges are typically bullish continuation patterns, and we're now in the compression zone where these patterns tend to resolve. The moving average picture shows complete bearish alignment. Price is below the 10 and 21 EMAs, those fast blue lines, which indicates short-term bearish momentum. We're also below the 55 EMA in purple, the 100 EMA in yellow, and even the 200 SMA in green. When price is below all major moving averages, it's either a downtrend continuation or a deep correction setting up for reversal. The wedge structure suggests the latter. Key levels to watch: Support sits at 23 cents, which is also the volume profile point of control. That point of control tends to act like a magnet, so we need to be careful about price getting pulled back down. But it's also accumulated volume, meaning that level has proven buying interest. Resistance comes in at 50 cents, which represents the upper wedge boundary, and was a level that held multiple times in 2024 before that 500% rally to $3.50 in March. Fibonacci retracement anchored from December's $2.20 high down to the recent 20 cents low gives us roadmap levels. The 236 fib sits at 67 cents and the 382 at 96 cents. These are not arbitrary. They're where profit-taking typically happens in recoveries. The Heikinashi RSI is still in oversold territory, but starting to bounce and point upward. That's your momentum shift signal before price confirms it. Combined with declining volume through the wedge, which is textbook for these patterns, we have technical conditions supporting a reversal setup.
Here's my specific strategy. My load zone is 25 to 38 cents.
I'm dollar cost averaging through that range because I can't time the exact bottom. For short-term traders, my stop loss is a weekly candle close below the descending wedge. That invalidates the pattern. For my long-term position, I view this whole zone as accumulation, and if the pattern breaks down, I would look to re-enter around 12 cents. That's not what I expect, but that's my invalidation level. My take profit targets are layered. 50 cents for the conservative first exit, then 95 cents, $1.40, $2.20, $3.40, and I'm keeping a moon bag for $5.50. I'm trimming hardest at the second and third targets because that's where the Fibonacci resistance stacks up with previous structure. Trailing stops move to entry after first target hits, then to target one after the second hits. This is mechanical risk management, not hope.
The setup is simple, but requires patience. Best case, wedge breaks upward on volume. We reclaim the 55 and 100 EMAs, and the fundamental catalysts get priced in as the AI agent narrative strengthens into Q1 2026. That could target the $2.20 level, a 570% move from current prices within a 6-month window. Worst case, macro deteriorates, crypto dumps, and we break the wedge to the downside. In that scenario, I'm out of my trading position but watching for accumulation at lower levels because the fundamental thesis hasn't changed. What would change my thesis? If the ASI1 adoption metrics come out weak, if the DevNet launch gets delayed significantly, or if another project launches superior AI agent infrastructure that gains traction. I'm watching for execution, not just announcements. Short-term, this is a volatility play inside a wedge. Long-term, this is an infrastructure accumulation opportunity while retail's distracted. The probability math favors the setup, but it requires discipline to the stop loss if the structure breaks. So, bottom line, Fetch is trading at institutional accumulation levels while getting mainstream media coverage and real-world integrations. The descending wedge shows compression, the fundamentals show acceleration, and the risk-reward around 30 cents is asymmetric. I'm positioned in my load zone, stops are set, and I'm watching for that wedge resolution. If you found value in this breakdown, hit the like button and subscribe. I'm analyzing setups like this every day. Join my free Telegram group for faster daily updates. Links in the pinned comment below. The AI agent narrative is just getting started, and positioning matters more than timing perfection. Thanks for watching, never financial advice, and see you in the next one.